maybe by way of just a quick high-level overview of where we're going today. We're going to spend some time talking about probably what is front and center on people's minds, which is where are interest rates going in 2025? How should we be thinking about that? So we'll spend a fair bit of time framing that discussion. And then we'll transition into talking a bit about real estate with particular focus on the Victoria and Winnipeg market. So we'll try to get pretty granular and look at what's going on in those markets as well. Now, I will say that for the compliance purposes, I had to submit this presentation last week. As it turns out, we've basically had an entire year happen in the last week. So, there's a lot that's gone on, particularly as it relates to our Canada-US relations, et cetera. So we are going to get into some of that and talk a little bit about tariffs and what that might all mean. But let's just frame this up from a high level. This is probably the big question that everyone wants to talk about, which is where are interest rates heading in 2025? So what you're looking at on the chart is the expected Bank of Canada policy rate path. And so you can see the dots. This is where we were. You may remember we started last year with the overnight rate of the Bank of Canada at 5%. And then we had a series of 25 basis point cuts, a couple of really big 50 basis point cuts. And then we just last week had another 25 basis point cuts. And so the question now was, well, where do we go from here? Now, the dashed line is where the markets are expecting rates to go. And what the markets are expecting is one more rate cut in March, a pause in April, one more 25 basis point cut in June, and then that's it for the cycle. We're done. And so they're expecting a sort of a terminal interest rate of about 2.5% for this cycle, which would imply that we'll see mortgage rates get down to kind of 3.5%, give or take. Now, my conviction is that we actually have to get considerably under that. And I think at a minimum, we have to get down to 2% or possibly lower. And so what I want to spend some time walking through is why I feel that interest rates at these levels are still much too high and will be damaging to the economy, and why they must get a little bit lower. This, by the way, was a big topic in last year's discussion. You may recall I had a similar view that rates were going to have to come down considerably more than the market expected. That ended up being the right call, and I still think it's got to come down more than markets expect. But I will say, and I've bolded this part or highlighted it, this is a much more challenging forecasting environment today than it was a year ago. And one of those reasons is what we're going to talk about next, which is this whole tariff threat. Now, I put these together last week before we had some of the recent developments. The tariffs were threatened. They've since been walked back. As it stands today, we're looking at about a month where we're sort of left in limbo. But what I wanted to highlight is some great research from the Bank of Canada that was actually just released just last week with the interest rate announcement. And what they looked at is sort of a scenario analysis of what might happen to the economy in kind of that worst case scenario where we end up with 25% across the board tariffs, and importantly, retaliatory tariffs from Canada back to the US. And so it's an interesting kind of like a worst case scenario of what this might look like for the economy. So I want to put this up first because it at least gives us a baseline to think about tariffs. So the chart on the left is showing a number of different scenarios in terms of how Canada might respond, how business investment might respond. But what I want you to really focus on is the red bar. This is really kind of their main benchmark or kind of what they think is the most likely outcome. So in the event that we saw 25% tariffs and retaliatory tariffs from Canada back to the US, they would estimate that in the first year under that regime, we would see GDP growth in Canada fall by a little less than 2.5 percentage points. And then in the second year, we would see a further 1.5 percentage point decline. So that's a cumulative roughly 4% decline in GDP. To frame that for you, during the financial crisis in 08-09, we saw GDP in Canada decline by about 4.4% peak to trough. So we would be looking at sort of an economic shock that would be on par with what we saw during the financial crisis. Now, thankfully, it doesn't look like we're heading in that direction, but it's at least interesting to frame that. Now, What complicates things for the Bank of Canada is that even as you would have the economy under severe stress, we would actually see inflation increase. So what you're looking at the chart on the right is what would happen to inflation in the following 3 years. And this is in addition to kind of normal inflation, if you think about it that way. So in the first year, they would expect inflation to tick up modestly relative to what it was running. So it's currently running around 2%. So they would expect it would increase a little bit. But where it gets interesting is in the second and third year, you would see more significant increases in inflation. And now this would come through two channels. One would be the weaker currency. We saw that when we had the threat from the Trump administration around these tariffs. We saw the Canadian dollar fall, actually posted one of the biggest declines we've seen since the pandemic, but it fell about 1.3% against the US at peak. And then it's since, it recovered that. So one would be a weaker currency. We would import some inflation because, of course, we buy a lot of things internationally. And if our currency is weaker, that forces those prices up. But then the second is that we would also kind of do some self-harm in that we would be adding expenses on things that we bring in from the US. So, for example, orange juice, right? Where there was a threat that we would tariff orange juice. Well, that adds a little bit to the overall inflation bucket. So, a really challenging environment if this comes to pass. And it's worth framing that those threats are still hanging out there under the Trump administration. Now, in terms of as we look across the country, which parts of the country are most vulnerable to those US tariffs? It should not be a surprise that it's really the manufacturing hubs in Ontario and Quebec that have the most jobs vulnerable. And folks in BC, significantly less vulnerable, and Manitoba, really substantially less vulnerable still. And so this is not to say this is how many jobs we would lose, but this is the cumulative amount of jobs in the sectors that might be most impacted. So this is really going to be a story primarily for central Canada feeling the bulk of the pain if, in fact, these tariffs come to pass. Now, I had a chart here on why I thought the tariffs would not stick, at least this first round. And as it turns out, it looks like we're heading in that direction. And I think what's really important to remember is that Canada does have considerable leverage in some key areas like energy. And what you're looking at here, this is a chart of global oil production. It's a couple years old. If you notice the US is actually up to producing around 13 million barrels a day. And it's showing here about 11.6. But what people might find surprising is that the US is actually already the world's largest oil producer. It's ahead of Saudi Arabia, it's ahead of Russia. And so in a sense, they're a oil superpower. But what a lot of people don't realize is the refineries in the United States are decades old, and they do not refine the oil that the US produces. The US produces a very light type of oil that's very low in sulfur content, and that's coming out of the shale patch. And that's important because in order for them to refine their own oil, they actually have to blend it with a heavier version of crude, like what we produce in the tar sands. And that's the only way that they can actually efficiently refine it. And so they desperately need our oil to be able to refine their own. And so one of the things as I was thinking through this whole tariff, that I thought, it's really not likely that we're going to do a massive trade spat around this. They cannot tariff our energy without significantly driving up their own oil prices. And that's one of the quickest ways to become unpopular as a president, is to have oil prices rise under your watch. So I thought that was really unlikely. I thought a base case was much more likely that we would see no tariffs this round. And if you listen to some of the comments from folks in the Trump administration, like Howard Lutnick, who is their trade czar, he sort of hinted that this first round of tariffs was really related to their perceived national security issues around border security, and that it was meant to sort of snap their border partners into line around securing the border, but that later this year we would get more permanent tariffs that would be lower and would likely, I believe, be more in the 10% range on non-energy manufactured goods, and no tariffs on energy. I think that's where we're going to land. And under that scenario, we have a much more manageable 0.5 percentage point hit to GDP, a modest uptick in inflation due to some modest retaliatory measures, and probably on the order of 50,000 jobs lost, mostly on Ontario and Quebec. Not good by any means, but manageable. What it does mean is it gets back to my earlier point that in this scenario, the Bank of Canada is going to be under pressure to cut rates because it will be a softening economic environment. So that's enough on tariffs. Let's get into the broader picture of the economy and why I still think that rates have to get lower. And I want to start here looking at what's happening with Canada's labor market. It is starting to get a little bit squishy. It's not terrible, but we are starting to see signs that it's getting a little bit, this cycle is getting a little bit exhausted. And so what I would point you to is payroll employment. If we strip out the public sector, which is accounted for a significant portion of job growth, we find that private sector payrolls are actually declining on a year-over-year basis and have been for most of the past 6 months. So we haven't seen that since the pandemic. The private sector is starting to hurt. It's really the government sector that's now carrying the load. That's not a good signal for long-term growth. Concurrent with that, if we look at what's happening with the unemployment rate nationally, we've seen it rise from a low of a little bit under 5% up to about 7% today. So we've seen about a 2 percentage point increase off the lows. It's still in the context of our history, it's not alarmingly high. But any time in the past we've had the unemployment rate rise to roughly 2 percentage points in this frame of time, it's typically been just ahead of a recession. And so there are some signs here that the labor market is starting to soften out. If we look at what's happening with GDP growth, we just had the November GDP growth. The monthly number it posted the largest decline we've seen in the last 2 years. If we take that number and we take Stats Canada's preliminary estimate for the fourth quarter, we end up with a slightly positive fourth quarter. But then when we adjust it to reflect our per capita or the growth per person, it's actually slightly negative. And this continues with a string now of 7 consecutive quarters where per capita GDP has declined. And this is really the relevant measure because it's not. Our concern is not how big is the economy overall. Our concern should be how big is each person's piece of that pie, right? Because we can grow the economy a lot by bringing a lot of people here, but that doesn't necessarily mean that we're all becoming wealthier. So this is an important measure. We've now seen 7 consecutive quarterly declines, and look at what this means for this chart. Per capita GDP, Canada and the US has tracked very close to each other going back to the 60s. And in the last 10 years, we've seen a notable change in trend here where the US continues to rise. Canada's now been stagnant. Our per capita GDP is unchanged now over the last decade. So it's not a very robust economic backdrop. And these interest rates are not helping. Let's talk about the Canadian consumer. This is still a major part of our economy. Depending on the measure, we're still looking at somewhere around half of GDP growth coming directly from consumer spending. Look at what's happening with consumer confidence. If we look back in history, this is the financial crisis right here. You may recall we were afraid that the financial system was melting down before our eyes. This was the COVID pandemic. We were concerned that this novel pathogen might kill half the world or who knows what. And here we are today. We're effectively, consumers' sentiment on the economy is about as low as it's been since the financial crisis and the COVID pandemic, which is really quite a statement on the state of the consumer and how people are feeling about the economy in Canada. It's not just sentiment. We can see it in the data. What you're looking at here is Canadian Tire's same-store sales. Now, I'm not trying to pick on Canadian Tire. I just happen to think that Canadian Tire is a very good barometer for how consumers in Canada are spending their money. And if you think about Canadian Tire, it has a lot of things that people use every day, but it also has some things that are more discretionary. It's things that you would spend money on if you had extra money. And if you don't have extra money, you would kind of cut those things out. Okay, hobbies, kids sporting goods, that sort of stuff. And what you'll notice is Canadian Tire's same-store sales are also posting about, we've seen about almost 7 consecutive quarters of declining same-store sales on a year-over-year basis. I think this is all related. This is all just a function of consumers having less free money to spend. And that's being reflected in some of these kind of bellwether Canadian retailers. So again, just the economy's not terrible, but it's just soft. It's just not as good as it should be. And I think part of that is related to these rates. Now, the bad news, unfortunately, is that this issue around mortgage rates is about to come to a head in 25 and 26. So the chart on the left is showing mortgage renewals each year. Now, folks on the call will understand that in Canada, unlike in the US, we have mortgages that renew fairly regularly. In the United States, they have 30-year mortgages. You take a mortgage once, whatever the rate is, that's your rate for as long as you want, unless you refinance it and get a lower rate. So you can have a 30-year fixed rate mortgage in the US. In Canada, we don't have that. And in general, most of our mortgages are 5 years, well, on average. About 80% of mortgages in Canada have 5-year terms. So if we look at the renewals in the next couple of years, we have a big year in 25 and then a huge year in 26. So we have not quite 60% of mortgages set to renew in the next 2 years. And if you look at the chart on the right, these are mortgage originations on sort of a 12-month rolling basis. And I want you to remember mortgage originations, this is not just new loans, but this is also capturing renewals. And what we saw is during the pandemic in 2020, and I guess after the pandemic, kind of late 2020 to early 2022, we had those crazy low mortgage rates. And what happened? Everybody in Canada refinanced. They all took new mortgages, and we had this big boom in originations. And that's what you're seeing right here is as we start to lap that 5-year mark of this boom, all of these mortgages will be renewing. And if you look at the far right of this chart, look at this uptick right here. This is telling us that the leading edge of this boom is starting to refinance again and renew. And so you will see a repeat of this boom in the next couple of years. This will get higher and higher as these loans are starting to renew. Now, in terms of what this means for borrowers, let's take a minute and look what's happening to mortgage rates. If you look at the chart on the left, we have just sort of a rough estimate of a really good variable rate and a really good fixed rate. What is it today? They're both right around 4.3%. So if you want to know kind of a decent mortgage rate, that's a pretty good barometer. 4.3% right now is a good 5-year rate. Now, I want you to notice that's a heck of a lot better than where it was, right? There was a period of time there we were pushing 6% across the board. 4.3% sounds pretty good in comparison. But I want you to notice if we instead of having both variable and fixed on the same chart, if instead let's just take the very best rate between both of those. Okay, so the very best widely available rate, regardless of whether it's fixed or variable, you'll notice that back in 2020 to 2022, which coincides with that big boom in originations that we just looked at, we had mortgage rates down in the 1% range. So this rate here, I'm just going to go back for a second. That corresponds with this boom right here. So you had this boom in lending, all of it concentrated in this kind of like 1 to 2% mortgage range. And here we are today. At best, you're going to be refinancing into kind of or renewing into a 4.3% range. So to go from kind of 1.1 to 4.3%, you're still looking at roughly a 40% increase in your monthly payments. That's going to be manageable for some people, for most people, but it will mean just less of money available to spend on things in the economy. And that just kind of throws some sand in the gears of the economy when people have less discretionary spending power. So that's why I worry that a lot of the interest rate issues are going to hit later this year and into 2026. And again, just reinforces my view that these rates are still too high to absorb some of the issues that are coming. I do want to point out that it's unfortunately not just households in Canada. Consumers get a lot of press regarding how much debt they have. It's kind of a well-known fact in Canada that we have a lot of debt at the household level. But I want to point out it's not just households. If we also add in business debt, and then we add in government debt at different levels, Canada is very high globally in terms of our overall debt level. Okay, we're actually third in the world behind Japan and France for total non-financial sector debt. And you can see here's the US. They're about 70% GDP percentage points behind us. And here's the G20 average. So my point is the overall Canadian economy is extremely sensitive to higher levels of interest rates. It's not just households, it's also businesses, it's also government. We have a lot of sensitivity to these rates. Now, it does create an interesting dynamic. Canada needs lower rates, but the US really does not. I mentioned a moment ago that in the US, they have the luxury of having 30-year fixed rate mortgages. So one of the things we've seen in the US over the last few years is that the debt service ratio for households has gone down, even as ours has gone up. So let me explain what this means, because I believe this is one of the most important charts in economics today. So the household debt service ratio is the share of household income at the national level that is required to service household debt at the national level. And so as this number gets higher, it means there's less money available for spending. There's more of it being directed towards interest payments. And as it gets lower, it means the opposite. Now, notice in the US, they are near record lows for their respective household debt service ratio. This is because after the financial crisis, there was a lot of debt that was either paid down or that they defaulted on. And if you default on debt, the banks eat that cost and it kind of disappears from the system. So there's a lot less debt on the household balance sheets in the US, and they've been able to term it out for 30 years. So they have not felt the impact of these higher rates in any meaningful way yet. Whereas in Canada, we're sitting near record highs for our respective household debt service ratio. So this suggests that we're going to see a continued divergence in interest rate policies between the Bank of Canada and the Federal Reserve in the US, where the Federal Reserve will have to keep their rates higher and ours will have to get lower. What this means is when you have a discrepancy in interest rates between two countries, typically capital will flow into the country that has the higher interest rates, and it will it will flee the country with the lower interest rates, and that generally gets vetted through the currency. So what you're looking at here is the chart, the Canadian dollar versus the US dollar. You can see as of last week, anyways, we were around 69 cents the US dollar. The all-time lows was around 62 cents. Now, I have a strong conviction that before this cycle is over, we're probably going to retest those all-time lows, if not break through them, because primarily of this dynamic. We need lower rates. The US needs higher rates or stable rates. That creates some interesting dynamics down the road, but we'll talk about that in a moment. One more point on this whole interest rate. Let's remember why interest rates got as high as they did to begin with. They got up to 5% back in 2024 because of the rising consumer price index. We had an inflation issue coming out of the pandemic. Let's just be really clear, that inflation issue is now behind us. So if we look at inflation in Canada, it was about 1.8% last month. And what's interesting, what I didn't include in this presentation, but if we strip out of the headline inflation, if we strip out the component that's just related to interest costs, it's been running around 1% for the last year. So let me just state that one more time, because it's a bit of a weird thing in Canada. In Canada, one of the things that goes into the inflation basket is interest rates, which is a strange way to think about it, because as the Bank of Canada raises rates to fight inflation, that one part of the inflation basket starts to rise. And so today, headline inflation is 1.8%, but almost a full percentage point of that is just interest costs. So if we strip that part out, we're running about 1%. So really not a concerning environment. And then secondly, the other point that I would make, and we talked about this last year, but notice that consumer expectations for inflation continue to trend lower. This is really important because inflation has a psychological component to it. If you are worried that prices are going to rise in the next year, you're probably more likely to go out and buy things today, right? And I think I used the example last year. If you wanted to build a deck on your home and you were afraid that the cost of lumber and the price of labor was going to go up like 30% in the next year, you'd probably go out and you'd build it today. Maybe you'd borrow off a line of credit. You'd get it built sooner, right? And similarly, if you were a business, let's say a manufacturer, and you produce some sort of a widget, and you required raw materials to build that widget, and you were worried that those raw materials were going to jump 30% in the next year, you'd probably go out and you'd stock your shelves today. So when you have that dynamic across an economy, right, where people start to fear future inflation, so they pull spending into the present, that actually creates the inflation that people are concerned about. And it becomes this kind of self-feeding cycle where fears of inflation create inflation, which creates fears of inflation. You can see how that kind of spirals. And so This may not seem like an important chart. It's actually incredibly important if you're the Bank of Canada. They monitor expectations for inflation like a hawk, and it's very important now that this measure is now back pretty close to the long-term average. So the Bank of Canada has a lot of room to cut rates. Now, I mentioned a moment ago the currency, and this is the one thing that I think is going to become potentially problematic later this year, is that because of the weak currency, it does import some price pressure, some inflation as it relates to things that we buy internationally. And so we had just last week Metro, the food chain, come out and basically warn that, look, the loonie's getting pretty weak. We bring in a lot of food out of Mexico, the US. A lot of our produce is brought in internationally. And when our currency is weak, we have to pass on those pricing pressure to consumers. This, I think, is going to be a story for the second half of the year. But between now and then, I think the more pressing concern, if you're the Bank of Canada, is that interest rates are still too high, particularly in a time where we have a lot of mortgages renewing and facing 40% plus increases in monthly payments. That, to me, is the bigger risk to the economy in the short term. So that's kind of a high level view of where I think things are going. So just to reiterate, if I just pause here and give a quick summary, I think the overnight rate from the Bank of Canada needs to get to 2% or below, which would imply that by the summer, I think there's a very good chance that we will see mortgage rates in that kind of low 3% range, which I think is going to help a lot. There's a big difference between going from a 1.1% mortgage rate to a 4.3 and going from 1.1% to 3%. That difference in that payment shock is much more manageable, and I think that's ultimately where we have to get to. So let's talk quickly about housing trends, and then we'll turn it over to some questions here. We saw a nice little pickup in home sales in late 2024, kind of in line with those Bank of Canada rate cuts. It took a little while, but those rate cuts are starting to filter through. We're starting to see a little bit more activity. In British Columbia, they're not great, to be perfectly frank, but they notice that they are trending higher, but just way below the kind of previous boom peaks that we've seen in kind of that 2015 period, 2021 period, but trending higher. So these lower rates are starting to help at the margins. What I find is more interesting is what's happening in Manitoba. And here, notice that sales were pretty boring for most of the 10-year period from 2010 to 2020, pretty flat. And then we had this post-COVID boom that came right back to baseline. But then notice that very quietly, we've put in a really strong run for home sales across Manitoba. And it's now at a point where home sales are well above levels that we've seen in the past decade. It's one of only a couple of provinces across the country where home sales are above average for the last decade. So you're seeing some solid momentum coming out of Manitoba, and a lot of that's related to much better affordability than in other parts of the country, which we'll talk about in a moment. The other thing that I think is really interesting as we look across the country is we're starting to see a real divergence in terms of what's happening with inventory levels. So how many homes are listed for sale across an area over time. And what we find in British Columbia is that the number of homes listed for sale is currently about as high as it's been in the last 10 years. Okay, and this is adjusted for seasonality. So we can compare it across time. And notice it's effectively, it's more than doubled off the lows. So really interesting. But look what's happening in Manitoba. We had, after COVID, you had the big drop in inventory levels. It perked up when we had the interest rate hikes. And now it's just rolled back over and is grinding lower again. It's really slim pickings in terms of inventory levels right across the province. And I'm sure folks on the call can attest to this. There's just not a lot of quality inventory out there. So very interesting dynamics between British Columbia and Manitoba, a broad divergence. And that's really the story across all of Canada right now, is that we're seeing this huge difference in the trends based on geography. It used to be that most of Canada kind of moved in the similar direction. Everything kind of boomed at once, everything slowed at once. And today it's really different. We're seeing different pockets perform very differently. So here's a quick way to kind of visualize the market balance. So this is something called the sales to new listings ratio. And so a simple way to think about this is a higher number means the market is stronger. Okay, it means that more sales are being are happening relative to the level of supply. It's a measure of supply and demand. Okay, so high means strong. You can see Victoria perked up quite sharply in the back half of the year. Not back to kind of those boom times, but considerably better than we saw in 23 and early 24. But look at Winnipeg. Really strong performance. So we are now looking at this number for context. It's about 60% in Victoria. It's about 75% in Winnipeg. That is a really strong market when you look across the province. For context, Toronto is under 40% on this measure, and Vancouver is about 45%. So some of the big metros that used to be the real powerhouses that drove the national housing market are really looking squishy. And some of these secondary markets are picking up some of the slack. And Winnipeg at 75% is really strong historically. So both markets doing well, but Winnipeg's starting to look really interesting. Now, in terms of what's driving this, we are seeing a modest improvement in affordability. I think the way to summarize the affordability picture is it is not great by any means, but it is getting better. The chart on the left is showing the affordability at the national level. This is data from the Bank of Canada. And what it looks at is the share of housing-related expenses as a share of disposable income. Okay, so in other words, if you bought a home today, given the average household income in Canada, what percentage of that income would be consumed by mortgage payments, taxes, et cetera? And you can see that we hit this crazy high peak that was effectively an all-time high, and we've come off sharply since then. But if you just draw a straight line across, we're still at levels we haven't seen since the 90s. So, it's a good news, bad news story. Good news is it's getting better. Bad news is we've got a long ways to go. But this really breaks down geographically. And this, I think, gets into the difference between why Winnipeg looks so good and why Victoria, while it's looking better, is not great. So what you're looking at on the chart on the right is if you imagine purchasing a typical home at any point in time, what would your monthly mortgage payment be to afford that home? So assume you put 20% down, assume you got a 30-year mortgage, assume you got good mortgage rates. What would it be? And you can see the trend in Victoria. It spiked. By my math, you're still looking at about $3,500 a month to afford the typical home. That's well above the Canadian average, and it's way above where it was back in 2020, 2021 in Victoria. Contrast that with Winnipeg, which also is up, but to a much less extent. Right? We have not seen the same deterioration in affordability over the last decade in Winnipeg that we have seen in Victoria. And so I think this goes a long ways towards explaining why the Winnipeg market has been relatively resilient. And this brings us to this point around pricing. So we just saw that the markets are performing quite differently in terms of the supply-demand dynamic. That's being reflected in pricing. So the chart on the left is showing the house price index in Victoria. Notice that today, according to this index, prices are basically where they were 4 years ago. Now, I know there's going to be considerable difference by neighborhood, by geography, by property type, but as a broad generalization, if you were to sell a home today in Victoria, you'd get about what you would have gotten back in 2021, give or take. So not a lot has changed, it's gone up and down, but call it flat. Contrast that with Winnipeg, which also had a bit of a pullback when interest rates started to rise, but has since recovered and is now at all-time highs. So two very different dynamics between the two regions. And I have to say, I think this is probably going to continue at least through the first half of the year. I think Victoria is going to do better than it was last year, but it's probably going to chop more or less sideways from here, where Winnipeg, I think, has some room to run just based on the lack of inventory, the relatively strong demand profile, and the affordability picture. So I want to shift gears a little bit. There were some questions that came in ahead of time related to investing in real estate. And so I just want to comment on a couple of really important things to watch in the next year. From a high level, like I want to be really clear, I'm not giving financial advice. I'll refer everyone to Andrew. But what I would say is if you are considering getting into the rental market today, just be mindful that we're going to have a different looking rental situation in the next year or two than what we've seen in the last few years. And this is really a sea change in Canada. And it's one of the reasons also why I think interest rates have to go lower, because we're going to see a significant slowdown in population growth. which is going to in turn also affect economic growth. And so what are we talking about here? Let's rewind and let's look at what's happening in Canada with this cohort called non-permanent residents. Okay, non-permanent residents. So these are people who are in Canada on a temporary basis. 2 years ago, we weren't really talking about non-permanent residents. Today, it's kind of everywhere in the news because it is such a rapidly growing part of our population. So who are we referring to when we talk about non-permanent residents? It's really three main cohorts. It's people who are here on work permits, people who are here on study permits, and some people have both work and study permits. And then it's also this group of asylum claimants. So if they're here claiming refugee status, et cetera. Now notice that we're now over 3 million in Canada, non-permanent residents. 2 years ago, it was just barely over 1.5 million. So we've effectively doubled that level in 2 years. And if we look at this non-permanent resident cohort as a percentage of the total Canadian population, it has rocketed up to about 7.5% of the total Canadian population. Now, if you follow politics at the federal level, you follow policy around immigration, you'll know that the federal government has come out and they've said, we want to get this number from the current levels around 7.5%. We want to get it back towards 5% within 2 years. The way they're going to do that is they've already tightened up a number of policies around work permit holders. They've dramatically tightened up study permit holders, and they're starting to tighten up around asylum claimants. Okay, so they're really tightening around those three main cohorts. And what that means, now I want to be really clear, these are not my projections. This is directly from the Government of Canada's own projections. What that means is they are targeting a reduction of 400,000 non-permanent residents annually for the next 2 years. So this chart on the left is showing the various components of population growth going back to the 1980s. And really, population growth is made up of three main things in Canada. One is the natural increase, which is this gray bar. So this is births minus deaths. This is the number of Canadians being born minus numbers that are dying. It's almost zero today. We really have no natural increase in Canada. All of the growth is coming through immigration. But immigration comes in two forms. One is permanent residents, which is what we tend to think of when we think of immigration. This is the federal government's, used to be 500,000 target. It's since been reduced, but that's that blue bar. That's pretty stable every year, and that's not really going to change. But notice non-permanent residents. This orange bar is really what drove that boom in population over the last few years. And this is now the cohort that the federal government is trying to target. So they're aiming for a 400,000 reduction in population in each of the next 2 years, in 25 and 26. And if they achieve that, it will take the total Canadian population negative for 2 years. So we will go from a 3% population growth rate to roughly minus 0.2% for 2 years running. Now, I'll just tell you, this temporary resident cohort is a huge driver of rental demand. Right? If you think about it, international students, temporary workers, they're all renters. So when you go from adding 800,000 in 1 year to then all of a sudden subtracting 400,000 for 2 years running, I think it's going to be a very different rental landscape this year and next year than what it has been. And by the way, if we look across the country, the various growth rate, we see a significant divergence in the different provinces around growth rate. All of these will go lower. But I still think Alberta is going to be relatively strong. Manitoba is going to be relatively strong. And then we'll sort of see from there. So that's what the population growth profile looks like today, but it's going to be very different. Now, the one question in all of this is the feds are telling us they're going to try to do this. The one thing that could complicate things is we don't yet know how many people we'll have coming north through the border trying to flee the deportation orders under the Trump administration. We don't know. That's sort of an unknown, but that could complicate things. Barring that, the federal government looks very committed to this particular goal. So that's one part of the equation. That's more looking at the demand side of the rental market. Now let's look at the supply side of the rental market. And I can just tell you that we are seeing a huge surge in rental apartment construction across the country. It is true both in British Columbia, where we're at record highs for rental apartment construction, and it's true in Manitoba. We're off the highs, but still very elevated compared to where we were 10 years ago even. So that's a lot of supply. To put some numbers to it, nationally, we have about 6% of the existing rental stock under construction. So what that means is over the next 2 years, the number of rental units available across the country is going to grow by 6% into an environment where there's not going to be a lot of rental demand, right? A lot of new rental demand because, of course, the federal government's trying to tighten that. But notice how it breaks down. In BC, it's 15%. So we have 15% of the existing rental stock currently under construction. Another way of saying this, if we look at the national numbers, if we just assume that there's no rental demand over the next 2 years and all these units complete, vacancy rates will rise by a little under 6%. So that's a very different rental market than what we're seeing currently. If we look across both British Columbia and Manitoba, currently today vacancy rates they're still very low. They're rising in British Columbia. They're still very, very low in Manitoba. A simple way to think about this is we're going to at least go back to long-term averages this year, if not get considerably above those. It's not hard to get to a 4% vacancy rate when you have 15% of your existing stock under construction in British Columbia. And I could easily see this going to 4% in Manitoba, which just means it's a very different rental environment. You're going to have slightly more vacancies, slightly weaker rent growth. We're already seeing rent prices come down in many parts of the country. That's going to continue in 25 and 26. If I can leave you with one good news story, and then I'll turn it back to Andrew here real quick. We talked about this last year. It's still the same story. While I worry that we have a lot of rental buildings under construction, we have a lot of condos under construction in British Columbia, what we don't have are single family. In fact, single family building permits are at the lowest level we've seen on record going back to 1980. We are just not building single family in British Columbia. It's just way easier to build a rental property than it is to build a single family home. So over the longer term, I think these are still going to hold their value. A little less true in Manitoba. Obviously, it's a little easier to build in Manitoba than it is in some of the more supply constrained markets in British Columbia. But even there, given how tight the resale market is, we should be seeing more construction activity, and we're just not. And so I think that in 25, 26, one of the big winners will be single family homes. One of the areas that will not perform as well is rentals. And we'll see from there. So with that, I will turn this back over to Andrew and Raylene, and I'm happy to take any questions from here if we have time.
Awesome. Thanks, Ben. I was going to jump in a couple times there, and then you answered my question. This is fascinating. Appreciate that you put this together last week, and like you said, we've had about a year kind of passed between this week and last. Seems like from the or at least initially the round of scary looking tariffs aren't totally coming through. And that's kind of what I was hearing from lots of the cooler heads that we listened to. In fact, the administration was saying itself that a lot of the reason for the tariffs wasn't for tariff's sake. It was to get some motion on some other topics. But it sounds like those cooler heads, and you're one of them, and agreeing with them that the idea of tariffs hasn't necessarily gone away. We get about a month here of I don't know, pause doesn't quite seem right, because I think everybody's going to be pretty nervous during that time, wondering what's going to happen. But I guess a month of no activity, time to get things straight, and then expecting that there are probably going to be some tariffs going forwards. And I think we can expect that the U.S. administration is maybe going to paint things with a broad brush, or maybe zoom in on some sectors where it thinks it can bring some advantage to the American market. I know that lumber's a topic in conversation, and has been for decades. Trade in lumber between Canada and the U.S. Do you think there's any do you think that would have any impact on the supply and building permits and maybe the progress of the industry here in Canada?
Yeah, look, I think in general, the one thing we can say about tariffs is that they just gum up the wheels of commerce, and they mess up efficiencies. They make everything more expensive. And not only that, they do a lot of damage to the economy, because a lot of the needed investment that should be pouring into businesses in terms of expanding, looking for new markets. None of that happens when you have this threat of tariffs hanging over us. So that's one of the things people aren't talking about is like, yes, we've dodged this initial tariff bullet. But if you were thinking about, let's say you owned a manufacturing company, like, are you expanding in this environment? Like, no. So everyone now is just going to be sitting on their hands. It's not good for productivity. It's not good for economic growth. It adds, if they do come in, it will add to pricing pressure across the board because it just gums up efficiencies. And that's really one of the real stories in all of this.
Yeah, and I get the points that you were saying too about the Bank of Canada having to be careful about managing interest rates right now and the effect that it could have on the currency. It's something we've been thinking a lot about. Really simply, like you said, if rates are really high in the U.S. and low in Canada, people are going to go invest in the U.S. instead of Canada just to get the higher rate and capital flowing out of Canada into the U.S. or into the U.S. more than into Canada puts negative pressure on the Canadian dollar. Now, of course, that's got an impact on investments too. The weakening Canadian dollar. If you're a Canadian investor with investments across the world, a diversified portfolio, and investments in the U.S., that's actually good news for your investment. So maybe a little bit of a ray of hope there for folks with investments in the U.S. And we saw in 2024, I think the currency rate fluctuated quite a bit, but year over year, I think it was about an 8% weakening in the Canadian dollar, which means all else equal, U.S. investments held by Canadians went up by 8%. But of course, you brought up that chart. You think we'll be testing lows, and whether or not that happens, the chance that it snaps back in the other direction, not urgently, but any kind of change in the situation that results in the strengthening of the Canadian dollar, relative strengthening of the Canadian dollar, is going to end up being negative for investments. So, on the one hand, you've got the Canadian economy versus the U.S. economy. Do you want to be invested in Canadian stocks versus American stocks? I'd say probably both. But when you come to be invested in U.S. stocks as a Canadian citizen, where the majority of your expenses are in Canadian dollars, where do you want to place those international investments? So we're watching that currency rate too, and if it does come to test those all-time lows, around the low 62 number, we're going to be thinking pretty carefully about where positioning the portfolios should be.
Yeah, and it's a great question. And I see there was a great point. There's a question that came in around precious metals, and maybe I'll jump in because I think it segues into what you just said, which is that people need to remember that when we have a situation where our currency is declining, one of the things that becomes really attractive are companies that sell in US dollars but have expenses in Canadian dollars. And so a great example of that is, as one example would be companies in the resource space. So if you're selling oil in US dollars, but you're paying Canadian wages, man, you mint money when the currency goes down, assuming that oil holds where it is. And that's also true. Somebody asked about precious metals. That's true of gold miners. If you're selling in US dollars and paying in Canadian dollars, this is a huge boon for you, for your bottom line. As it relates to precious metals specifically, I mean, I don't have an investment recommendation, but certainly in an environment where the Canadian dollar is weakening, anything that's priced in US dollars will have a natural tailwind behind it, and gold would be one of them. And I happen to think, again, not investment advice, but I happen to think that gold is interesting in that we're now in an environment where central banks are back to buying gold en masse. And I think that changed, if you remember back to when Russia invaded the Ukraine. And one of the mistakes that the US administration made at the time is to basically take all of their foreign reserves and threaten to basically zero those. And the entire world went, oh, shoot, now all of a sudden, all these things that we thought were safe collateral, these US debt that we owned, we thought it was safe. Maybe it's not as safe. And the moment that happened, you saw central bank buying of gold start to rise and rise and rise. And that's just continued. So I think personally, I think we're in a bit of a gold bull market that's probably going to persist for a few more years. But again, not investment advice. I will defer everything to Andrew and his team on that.
Appreciate it. Yeah, it kind of highlights the situation that Canada's in. I mean, we're sort of a resource center for the United States, and the U.S. being a reserve currency. That's how a lot of these resources are priced. So, gold, oil, silver, critical minerals, all of this stuff is is one of the reasons that I think Canada is economically in a great situation. We have all these resources as long as we manage them properly. I think it's going to be great for Canadians. I had a question about the about rentals. So we we see a big ramp up in rental supply, new rental properties coming on the market, but they seem to have mistimed it like exactly, or pretty close at least, because like you said, we're in a place where the government of Canada is forecasting that that they're going to have possibly net negative population growth, and a lot of the demand for these rentals is people that the government of Canada or areas of immigration that the government of Canada is looking to reduce. So, what brought us here? Did the market just mistime it and see, like, looking in Vancouver, people seeing prices skyrocketing? So, hey, let's jump on it. Let's start building stuff. But lag times are just years long in some cases. So they didn't quite get there long soon enough. Is that sort of what was going on?
Well, it's a little more nuanced, but in very simple terms, yeah, the fact that there's a lag between when you start construction and when it completes, you're exposed to kind of the vagaries of the supply demand market, right? And so, look, Canada's great at fighting the last fight, right? So we've gone through a period where we had a tremendously undersupplied rental market, and of course, the government, in their infinite wisdom, decided, why don't we throw a lot of resources at this problem? And one of the things that they've done is, through the Crown Corporation known as CMHC, which insures loans to borrowers, the government has said, we will insure the development loan on a lot of these rental properties. And we will allow people to purchase new rental properties with only 5% down and 50-year amortization. So they made the financing terms incredibly attractive, backed by all of us taxpayers. So naturally, if you make funding incredibly cheap and easy to get for developers, lo and behold, they develop, right? And they built a lot of rental supply. And so it's one of those situations where, Canada was kind of, the policy was correct. The magnitude and the timing was slightly off, and it just happened to coincide with this incredible pushback against what was clearly irresponsible immigration policies around temporary residents. 1.5 million in 2 years is just, we can all agree that we want a healthy level of immigration, and also recognize that 1.5 million in 2 years is just not a manageable number for our economy. And so they ran headlong into a huge public pushback on that issue, and were forced to tighten that just as all this supply was about to hit. So I just think it's going to be a very different rental environment for the next couple of years. I know you had a lot of questions come in related to that. Look, I just think you're going to have better opportunities a year, maybe even 2 years from now, where the prices will reflect a healthier vacancy rate, a slightly better cap rate. I just think you'll do better a year or two from now than you would today.
Yeah, I guess if you're looking at real estate for an investment, you're looking for low prices, and we're not exactly there. I mean, the future in BC and Manitoba might be a little bit different, but a bit of a stronger looking market in Manitoba, but still overall prices close to all-time highs and close to overvalued compared to other developed nations. You're looking for low interest rates, and they are coming down, but they're definitely nothing like what we saw a couple of years ago. And you're probably looking for, if you want to invest in real estate, you're probably looking for a market that's strapped for supply, and that's got really strong demand. And I think all of those things aren't quite lining up right now. So,
Yeah, totally agree.
and there might be some more opportunities in the future. Well, Ben, thank you so much again for joining us. It's great to hear you talk. I could listen to you forever, and we're certainly glad that we subscribe to your services. Like I said, you're one of those folks who always sees it pretty level, and it's good at separating signal from noise. And gosh, has there been a lot of noise recently? So we're glad that you're here talking to us. Thank you so much for joining us, and everybody have a great day.
My pleasure. Thanks so much for the invite back, and thanks everyone. Have a great day.